When someone forms a new business, they often wonder what legal entity type should they use to operate their business. Now, there are certainly legal reasons why you may choose one form or another, but I want to talk about the tax treatment and why you might want to make a decision about what type of entity to use. The default entity type is a sole proprietorship if one owner starts a business. You can even form an LLC, which offers some legal protection, but as a single member LLC, because you're the only owner, this is reported on the Schedule C inside your own tax return. Now, one of the advantages of this is that it's a pretty simple business form. There's not a lot of expense in getting it set up. You don't have to file a separate tax return because you were already filing your own individual tax return. Now, one of the problems is, although you can take the profits home, you can't be on actual payroll and have withholdings. You're responsible for self-employment tax, which on top of income tax is the Medicare and the Social Security that you would be paying if you were an employee, and the part that your employer would be paying if you were an employee. So this requires payment of estimated taxes and quite a bit of tax planning to make sure you pay in enough during the year and don't have any unpleasant surprises at the end. If you have more than one owner, then a business can't be a sole proprietorship, and a popular way to operate one of these businesses is as a partnership. Now, though it's not necessarily required, you should absolutely have a written partnership agreement that spells out exactly how you're going to split up the profits and the losses and what to do if one of the partners dies or doesn't want to be in the partnership anymore. Still a pretty simple entity structure. The partnership does file its own tax return, but it doesn't pay its own tax. It simply separates the income and the expense among the partners, and then they pay the tax on their own individual tax return. Partners still can't be on payroll, so you still have the self-employment and the estimated tax problem, but it is somewhat flexible because partners can, if the agreement allows, buy and sell shares, and the entity would keep going even as ownership changes. A corporation offers some additional flexibility because you can sell stock to raise capital, and then later if you want to expand or do more things, you can sell more stock to raise more capital. The stock can be bought and sold among people if the agreements allow, and so it's a very flexible way to run a business because the business has continuity even as ownership is changing constantly. Owners, shareholders, can be on payroll. They can get regular paychecks. It is a business with its own legal entity, so it has its own rights and obligations, but there's also a corporate veil. This means protection between the business and the people. The assets are kept separate, and so this is the greatest form of legal protection of any of the entity types. The biggest downfall is double taxation. The corporation pays its own tax on profits. If the owners then want to take those profits home, they have to take them as dividends, and they're taxable again. They're paying tax twice on the same income. Now, for corporations who qualify, they can make an S corporation election, which is electing to be taxed as an S corporation instead of a C corporation. For these entities, they're treated a lot more like a partnership. The company still files its own tax return, but it doesn't pay tax. The income gets distributed to the shareholders who pay the tax on their own personal return. Shareholders can still be on payroll. Owners can take home profits without paying double taxation as long as they have enough basis in the company. Now, you do need articles of incorporation, and you also want to make sure that all distributions are always in perfect ownership percentage, or you can lose your S corporation status.